Welcome to the Kaiser Report. I'm Max Kaiser. Did you ever get the feeling that nobody actually knows what they're talking about? That politicians, central bankers, and unelected bureaucrats are just talking out of their bottom? It appears you're right. They've just been making it all up, Stacy.
Max, when you look out across the world and we've had this financial debt collapse, one thing you've noticed, the response that unifies all our Western nations is austerity. Make the people pay for the sovereign debt crimes that were not sovereign debt crimes first, but were financial debt crimes first of all. So there's been a big little oops this week. Reinhart and Rogoff, yes, we made a Microsoft Excel blunder in our debt study, and it makes a notable difference. So this is Carmen Reinhart and Ken Rogoff, and they wrote a book, which is now basically the policy template. Before there was a Cyprus template, there was the Reinhart-Rogoff template. The book is called This Time is Different. And they said that anytime sovereign debt gets to up to 90% of GDP, it causes basically economic disaster, doom, low growth rate.
Well, there's a lot of different things you can say in response to this. My primary response to this would be that you've got some academics, guys who are not in the market, who don't have real jobs, who are poring over data, who are looking at textbooks and come up with a theory that they have a predisposition toward proving, and they're willing to overlook actual facts to get to the goal line of proving a theory. It turns out that the facts cited were wrong, the conclusions were wrong, the title of the book is wrong. It says this time it's different. No, it's exactly the same all over again. A bunch of wanky, bureaucratic, academic knuckleheads, whether it's these two idiots or Ben Bernanke, making academic assumptions that do not jive with the marketplace.
Yeah, and any investor knows that as soon as you hear those words, this time is different, you always know it's not. So the fact that all these policymakers around the world were duped by even the title. So let's go into what actually happened. What was this flaw? In an article called How Much Unemployment Was Caused by Reinhart and Rogoff's Arithmetic Mistake. So University of Massachusetts economists Thomas Herndon, Michael Ash, and Robert Pollan, referred to as HAP, looked at the data, and it turns out that the initial results were driven by simple computational and transcription errors. The most important of these errors was excluding 4 years of growth data from New Zealand, in which it was above the 90% debt to GDP threshold. When these 4 years are added in, the average growth rate in New Zealand for its high debt years was 2.6% compared to negative 7.6% that Reinhart and Rogoff had entered in their calculation. So if you restore those years, in fact, there's very little correlation to lead to their causation, which they say is the high debt.
It's inconclusive. You don't know whether the high debt causes unemployment or whether the unemployment causes high debt. What we do know is that policymakers and bureaucrats who follow this prescription and have imposed austerity in countries like Greece have caused massive unemployment and a massive plunging in GDP and a massive increase in debt, because they don't want to see the market simply do what the market does, which is to allocate resources and goods and services in a way that's better than having academics and bureaucrats and central planners who fail time and time again.
You know, there was real empirical evidence. All these austerity measures were imposed on Greece, on Ireland, on Spain, and it's spiraling worse. The debt is exploding, the unemployment rates are exploding, Molotov cocktails are exploding, and they kept on saying, no, but this paper, this book by Rogoff and Reinhart says this time is different.
Right, and when presented with the evidence, all we need now is for them to say, this lady's not for turning. You remember Margaret Thatcher, when shown the evidence that her policies were destroying the UK, said, this lady's not for turning. And as a result, unemployment went up, the economy shrunk. Now, of course, you had North Sea oil, which hid the fact that her policies were horrendous. And now you've got a post-Thatcher period where the inadequacies of her policies are becoming manifest. and we're going to see higher inflation and wage collapse. So this is what George Osborne and his ilk cite this guy and his work as reason for austerity in the UK. Are they going to now admit that their policies are based on completely faulty, corrupt data? Or are they going to stand up in Parliament and say, I'm George Osborne, he's going to wear some falsies and a skirt and say, this lady's not for turning. Based on his crying at Thatcher's funeral, I'd say he's going to dress up like Thatcher and do the Thatcher impression, which is going to hurt the British people.
I'm going to go over some of the quotes from heads of state and unelected bureaucrats who have basically imposed policies on taxpayers and citizens around the world based on this paper. Olli Rehn of the European Commission says, it is widely acknowledged based on serious research that when public debt levels rise above 90%, they tend to have a negative economic dynamism, which translates into low growth for many years. And Timothy Geithner said, it's an excellent study, although in some ways understates the risks. So here are guys setting economic policy. They have a whole team of hundreds of economists that work at the Treasury. Why didn't he ever even think to look at the data and test it himself? Because they wanted this outcome anyway. They fit the facts around what they wanted ideologically.
Right. Well, there's a double tragedy at play here because, of course, people like Paul Krugman and the money printers will say, you see, austerity's bad. Yeah. We need to print lots of money. But of course, they have an academic agenda as well. Paul Krugman doesn't have a real job. He's never had a real job. He doesn't have anything experience in the market or finance. He has an ideological objective as well. He'll use this to make errors on the other side of the debate by overstimulating, by flooding the economy with money. And as even Milton Friedman said, there's no connection between monetary policy and employment. But of course, will they cite that, even though that's their god, Milton Friedman? No. So again, neither Krugman nor these two jerk-offs respect the market, and they should, because the market is better than academics making arguments based on their own theories and then faulty data.
On Kaiser Report, we have interviewed Professor Steve Keen several times about this over the past few years, and he said Americans and many policymakers have this obsession with the government debt numbers, when it is private debt numbers that matter the most. This is what, according to Steve Keen's models, suggests. So I tweeted him and I asked, how many times have you said on Kaiser Report that it is private debt, not government debt, that matters? Hashtag Reinhard Rogoff. He responded, yep, Stacy, and I have a causal argument supported by correlation rather than dependent on it, and I don't use Excel.
Well, the private debt issue, of course, that would mean rolling back the activities of the private banks, who are in the business of accumulating. In this country, for example, in the UK, the private banks have 6 times the GDP of debt on their balance sheet, many times more than the national debt. But to include that in your calculations would mean admitting that you've got a rogue banking sector that's completely out of control. And then, of course, everyone's bonuses would dry up, so that's not going to happen either.
All the policy, because of this time, is different, they claimed. All the policy has been about cutting social services, cutting welfare benefits, cutting health care, all these things, education, where nobody cares about the private debt of the actual consumer. So you have the explosion of student loan debt in America, which is non-recourse. You can't walk away from that, like what happened with the housing bubble in America. You have the explosion of student debt here in the UK. Private debt, consumer debt, credit card debt is exploding. Nobody's doing anything to stop that. And in fact, they're encouraging it in order to say they are trying to save the sovereign debt numbers to get those to go lower.
Well, if you want central planners and academics to run your economy, then make a simple rule that the private debt should never be more than 20% of the public debt. So therefore, your banking sector, whatever they accumulate in debt, the public sector should be able to indebt themselves 5 times greater. The ratio should be opposite of what it is today. So you've got the public sector who's out there indebting themselves, but at the same time creating jobs, wages would go up, consumerism would increase, and you wouldn't have a banking sector that's gone rogue, that's dragging the global economy into the ditch. Now, if you want to impose a rule, if you want to be bureaucratic, impose that rule, or impose no rule. But don't let the private debts get to 5 to 6 times public debt. That's the worst of both possible worlds.
In the UK, you've had rising, these shock bad unemployment numbers, and the IMF has told them to back off austerity. But there has been one number that has always been telling the truth for the last 10 years, since 2002, 2003, and that's the price of gold. We know the price of gold, of course, had a huge crash, one of the worst ever, from Friday, Monday, and on through the week. Central banks find stimulus glitter in gold slump. The slump in gold may hand activist central bankers more reasons to pursue the easy monetary policy that helped drive up the metal's price in the first place. Central banks can be opportunistic and proceed with quantitative easing now the gold market is surrendering with regards to its hyperinflation fears, said Edward Yardeni, president and chief investment strategist at Yardeni Research in New York.
No, once again, you've got academics looking through the wrong end of the telescope and drawing completely ridiculous conclusions. Clearly, the price of gold pulled back because of all the paper that's been created as part of quantitative easing. The fact that they successfully flooded the market with naked short sales, that is, counterfeit contracts, and dropped the price down, they're using as justification to flood the market with more naked short sales and to print more money. There's not going to be any retraction from quantitative easing. Price of gold and silver is now at a point where the globe is buying hand over fist in a frenzy, and we're still heading to $10,000 an ounce.
But here again, relating it to what happened to Reinhardt and Rogoff, they just ignore the data that doesn't support their ideology. And here the situation is that they believe that quantitative easing should work, and it was the irrational price fear in gold, it was just the price was the wrong thing.
No, it
wasn't there.
It's like the story of the kid who shoots his parents and goes to the judge and says, "Your Honor, I need leniency because I'm an orphan." Here you've got global traders killing the price of gold and going to the World Banking Establishment and saying, "We need more bailouts because the price of gold just went down because we just shot it in the head." So they're always going to get more bailouts, and the price of gold will pull back on its way to $10,000 an ounce.
And the correlation and causation, again, they see that the price of gold is correlated to their policies, the insanity of their policies. So they think if they could just get gold to go down, that means their policies are no longer crazy. It's
right. If you're saying that the price of gold is correlated to your policies, then you're also saying that the world is on a gold standard. The world is on a gold standard today. That's the biggest joke of all. We're on a gold standard. These guys are making policies based on the price of gold. What does that you think that means? When Bernanke says it's just a trinket, it's just tradition, we don't respect it, he's lying through his teeth. All right, Stacey, thanks for being on the Kaiser Report.
Thank you.
All right, stay tuned for the second half, much more. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to go to Florida and talk with the father of Reaganomics, Dr. Paul Craig Roberts, a former official in Ronald Reagan's Treasury Department and author of a new ebook, The Failure of Laissez-Faire Capitalism and Economic Dissolution of the West. Dr. Roberts, welcome back to the Kaiser Report.
Thank you, Max.
All right, Dr. Roberts, gold fell violently in price despite it being in backwardation, a sign that physical markets are tight. Your thoughts on what has happened in gold recently?
Well, I think that the Fed is driving gold down to protect its quantitative easing policy, because when you create 1,000 billion new dollars each year, but the demand for dollars is not growing. In fact, more and more countries are no longer using it to settle their international payments. You get a huge difference between supply and demand. And so the Fed's quantitative easing threatens the dollar exchange rate. And a strong gold price is an indication that the dollar's exchange rate is untenable. So to protect the dollar from the effects of quantitative easing, the Fed periodically attacks it by loosing its bullion banks in the paper gold market with massive shorts.
The logic here seems like something out of a Dr. Seuss book, because the Federal Reserve recently said that because the price of gold is down, they can then ease and print more money, and they can introduce more quantitative easing. However, we know that the price of gold went down recently because the Fed and its cohorts on Wall Street shattered the price with naked short sales or Fed printing of more money or counterfeiting. then that, in fact, increased their net supply of debt. It increased the amount of money in the system, in the shadow banking system. But then they used that as justification to print more money to presumably help these insolvent banks. So still at this late stage of the game, even though the insolvent banks have proven to be money launderers, laundering money for terrorists, funding terrorism, funding Mexican drug cartels, rigging LIBOR, rigging gold, involved in mis-selling, involved in criminal activity, JP Morgan, Goldman Sachs, Barclays, HSBC. The Fed still protects them. It's still a protection racket. Your thoughts?
Well, that's right. But the crooks run the Fed, don't they? And they run the Treasury. It's the same executives who caused the financial crisis that run the Treasury, the regulatory agencies, and the Fed, of course, is their protege.
Dr. Roberts, just prior to the smash in gold prices by naked short selling, illegal short selling, the Fed accidentally released minutes which signaled a major change of policy. The minutes suggest the Fed may possibly wind down quantitative easing. What do you think of this, Dr. Roberts?
I don't see how they can do it, because if they do unwind it, what happens? What finances the $1 trillion federal budget deficit? And if they do unwind it, what supports the bond prices? The whole reason for quantitative easing is to drive up the prices of the debt-related derivatives on the banks' too big to fail books. And so they're trapped. If they stop quantitative easing and they're not supporting bond prices, then interest rates will rise, and the solvency of the banks will worsen, because the prices of the assets on the bank's books will decline. And of course, if interest rates rise, then the bond market collapses, the stock market collapses. So I don't believe a word about them unwinding quantitative easing. I don't know how they'll get out of it.
Now, I'm not exactly clear on the dates, but were you in the Reagan administration during the Plaza Accord? Because I believe that was the last time international country, got together internationally to reset global exchange rates after the kind of the post-Bretton Woods era. The Plaza Accord came in the mid-'80s. They had to readjust the parameters on the global forex trading and the currency grid. I think that was the last major time they did that. So here's my statement. There's not going to be an unwinding of quantitative easing, but there will be some new international conference to figure out how to readjust the global currency grid in one fell swoop. Your thoughts?
I think the Plaza Accord was during Reagan's second term, and Jim Baker had been moved from the Chief of Staff of the White House to the Treasury, and that was after my time. I don't know if there'll be another agreement. I think what's happening is individual countries are making their own agreements to simply avoid the use of dollar as international payment. The BRICS are making an agreement to settle their trade in their own currencies. Recently, it was announced that Australia has made this agreement with China. They're not going to convert their currencies into dollars and back out. Japan and China are working on the same kind of agreement. So it looks to me more like a move away from the use of a reserve currency, at least for countries whose currencies are stable, certainly more stable than the dollar. So I don't know that there will be another agreement, and don't quite see how they can have a real agreement when both the Federal Reserve, the Bank of Japan, and apparently also the European Central Bank are committed to printing money in order to achieve various kinds of bailout schemes.
Now, I don't know if you saw this or not, but just before the smash in gold coordinated by central banks, the price of gold in yen had actually hit a 40-year high. So here you had massive money printing in Japan, a new 40-year high in gold, and that was tipping people's hand that this money printing policy was in fact potentially hyperinflationary. I don't know if you saw that particular action on the markets. If you could comment on that. And secondarily, this accidental release of Fed minutes to insiders. We've seen, and also, we also understand that the rule, the Stock Act, Stop Trading on Insider Knowledge Act between Washington and Wall Street has expired, so that in fact traders and congressmen can trade on inside information. You were in Washington. They're openly releasing data ahead of market moving points, and they're trading on it, and they're just stealing money from the population. Isn't this kind of a new high watermark for corruption in America?
Well, I think the United States government now is probably among the most corrupt in the world, if not the most corrupt. Literally everything that is said is a lie, not just about economic policy and Federal Reserve policy, but about everything. Wars and foreign policy.
The recent league table that describes the countries around the world in terms of corruption, America is no longer in the top 20 in terms of the least corrupt. They are dropping precipitously down that scale. They're becoming one of the most corrupt countries in the world. And this Bernanke and the Fed in Washington are demonstrating exactly what it's like. Basically, Argentina, we saw during their collapse, America seems to be mimicking that pretty closely. Now, let's turn to your book for a second, The Failure of Laissez-Faire Capitalism. Explain how and why it has failed.
First, let me just run through the book, because the failure of laissez-faire is just a part of it. The book's in three parts, and what the first part does is it examines failures in economic theory, problems in economic theory, such as the economists who confused labor arbitrage with free trade and sat and cheered while the middle-class jobs were moved out of the country, leaving us with a huge trade deficit with a devastated middle class. So the first part deals with those kinds of problems. The second part shows what has happened to the American labor force. It, in effect, has been turned into a third world labor force, where the only available jobs are in lowly paid domestic services, so that the effect of the new economy is to have an undeveloped third world economy. And the third part deals with the current so-called sovereign debt crisis in Europe, and shows that it's being used to establish two things. One, that the public must bear the cost of mistakes made by private banks. And the other use of the so-called crisis is to take away the sovereignty of the individual countries by turning their budget and tax policy over to the EU. So that's what the book does. It walks you through basically the failure of economics, the failure of all of the apologists for the failed policies. Now, what happened with, why did I use the failure of laissez-faire capitalism? Well, if you look back over the last quarter of a century, it's been a century of massive deregulation and massive privatization. You know, Thatcher privatized England, deregulated, so did the French. And of course here it was extraordinary, particularly in the financial arena. They simply totally deregulated American finance, but they repealed the Glass-Steagall Act so that commercial banking is now lumped together with investment banking. They took the position limits off of speculators, so speculators can now dominate commodity markets. They got rid of constraints on debt leverage. And what happened? We didn't get libertarian nirvana. We got crony capitalism. They forgot that private power it can be just as abusive as public power. And
now,
so,
while this is going on, Dr. Roberts, the stock market's hitting new all-time highs, and of course, the majority of the media would point to that as proof of success. What are they getting wrong?
Yes, well, it's rigged too, isn't it? At least now. What do the banks do with all the money that the Fed funnels into them? They buy stock futures. Look, how can you have the stock market at all-time high when consumer incomes are declining, when the labor force participation rate is collapsing because there are no jobs, when retail sales are declining? What is the basis for this market? And we've had these amazing collapses. You know, we had the one at the beginning of this century, we had the one in '08, and there's one now pending. It's just a question of what sets it off.
All right, well, we're going to have to leave it there. Dr. Paul Craig Roberts, thanks so much for being on the Kaiser Report.
Pleased to be with you, Max.
All right, and that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I want to thank my guest, Paul Craig Roberts. His website is paulcraigroberts.org. If you'd like to send us an email, please do so at kaiserreport@rttv.ru. Until next time, Max Kaiser saying bye, y'all. Says this time it's different. No, it's exactly the same all over again. A bunch of wanky, bureaucratic, academic knuckleheads, whether it's these two idiots or Ben Bernanke, making academic assumptions that do not jive with the marketplace.
Yeah, and any investor knows that as soon as you hear those words, this time is different, you always know it's not. So the fact that all these policymakers around the world were duped by even the title. So let's go into what actually happened. What was this flaw? In an article called How Much Unemployment Was Caused by Reinhart and Rogoff's Arithmetic Mistake. So low growth rate.
Well, there's a lot of different things you can say in response to this. You know, my primary response to this would be that you've got some academics, guys who are not in the market, who don't have real jobs, who are poring over data, who are looking at textbooks and come up with a theory that they have a predisposition toward proving, and they're willing to overlook actual facts to get to the goal line of proving a theory. It turns out that the facts cited were wrong, the conclusions were wrong, the title of the book is wrong. Welcome to the Kaiser Report. I'm Max Kaiser. Did you ever get the feeling that nobody actually knows what they're talking about? That politicians, central bankers, and unelected bureaucrats are just talking out of their bottom? It appears you're right. They've just been making it all up, Stacey.
Max, when you look out across the world and we've had this financial debt collapse, one thing you've noticed, the response that unifies all our Western nations is austerity. Make the people pay for the sovereign debt crimes that were not sovereign debt crimes first, but were financial debt crimes first of all. So there's been a big little oops this week. Reinhart and Rogoff, yes, we made a Microsoft Excel blunder in our debt study, and it makes a notable difference. So this is Carmen Reinhart and Ken Rogoff, and they wrote a book, which is now basically the policy template. Before there was a Cyprus template, there was the Reinhart-Rogoff template. The book is called This Time is Different. And they said that anytime sovereign debt gets to up to 90% of GDP, it causes basically economic disaster, doom. University of Massachusetts economists Thomas Herndon, Michael Ash, and Robert Pollin, referred to as HAP, looked at the data, and it turns out that the initial results were driven by simple computational and transcription errors. The most important of these errors was excluding 4 years of growth data from New Zealand, in which it was above the 90% debt to GDP threshold. When these 4 years are added in, the average growth rate in New Zealand for its high debt years was 2.6% compared to negative 7.6% that Reinhart and Rogoff had entered in their calculation. So if we restore those years, in fact,